All right, we are live.
Right. Good morning, everybody. It's 11 a.m., so time to get this show on the road. As usual, I'll be running through a sort of summary of this week's news, the sort of more exciting stuff. Then we have a real treat for you this week, as I will then be bringing on our special guest, Nick Train of Finsbury Growth and Income. But first, the news. So, a few things I just want to quickly cover off. I'll say it's been quite a quiet week in investment trust land. The big thing is the sort of Alliance Trust Witan merger, which I'm going to talk about probably in quite some detail. We've also had interim results from bankers, and there's a couple of interesting takeaways from there. Similarly with JP Morgan Global Core Real Assets, that's had its annual results out, and there's a bit of strategy changes we quickly wanted to go over. And sort of finally, just quick nod to Home REIT, because they've put out an announcement this morning talking about the fact that actually we're probably going to finally see those long-awaited results. So first thing, Alliance Trust and Witan. So basically, these two titans of the investment trust world are going to merge, and it's going to be the largest investment trust merger ever. We've known really that sort of Witan, which is a 1.6 billion investment trust, has been in play since its CEO Andrew Bell announced his retirement earlier this year. Basically, Alliance Trust is a good fit for Witan's strategy, and a lot of commentators in the market, although we had sort of no idea this would happen per se, there was sort of no sort of advanced news or indication. It's not really a surprise. It's just a very, very good fit. And the way it's going to work is Witan's assets can be rolled into ATSTs, and they're going to form a sort of new beast called Alliance Witan. And the combined vehicle is going to have sort of net assets of about 5 billion once all is sort of said and done. It's going to retain Alliance Trust's investment strategy, and this is sort of the strategy that Willis Towers Watson have run since about 2017 when they sort of took it over. It's a multi-manager approach like Witan's. It's got 8 to 12 managers, but they basically each run sort of concentrated 20 stock best ideas portfolio, completely ignore whatever the relevant indexes are. There's sort of no consideration for those whatsoever. It's just all about the best ideas, all about starter selection. And it has been very successful for Alliance Trust. Basically, since Willis Towers Watson took that over, there's been sort of marked improvement in its performance. It sort of shifted up its sort of peer group ranking significantly. And basically, it's one of the best performing global funds since Willis Towers Watson took it over. And that was clearly an attraction for Witan's board. As sort of part of this, assuming that the deal proceeds, they've agreed to put in place a more competitive management fee structure. So you can expect an ongoing charges ratio in the high 50s. ATST's currently is about 0.62 and Witan's about 0.76. So, an improvement for all. Basically, it's suspected to save about sort of, £450,000 per annum of costs, assuming that, it's got this 5 billion size. There's going to be no change in service from Willis Towers Watson as a result. Basically, try and make the whole thing fit together. You're going to see sort of enhanced third and fourth dividend or interim dividend payments for Alliance Trust, basically to bring it in line with what Witan has been doing. So basically, Alliance Trust are going to see shareholders are going to see their dividends rebased upwards. And Witan's shareholders will see, sort of continuation of the gradual progression. So that's how the whole thing is going to be pieced together. Given where Alliance Trust is trading at and where Witan's been trading at, assuming the deal completes, you should see a sort of uplift in basically market value for Witan shareholders. Witan shareholders, because obviously they're going to be getting a different strategy, will be a very sort of similar one and better performing one, they're getting the option of a partial cash exit. So that's up to 17.5% of the fund at a 2.5% discount to NAV. I said before, obviously, this is going to create sort of quite a beast. If it all works, it's supposed to be about sort of 5 billion worth. So it's going to create a larger, more liquid vehicle. So it's going to work for everybody. Interesting thing is it will put it in the zone where it should be promoted to the FTSE 100 index. It's certainly eligible for inclusion. And it will be the fourth investment company ever to achieve this. Obviously, if you move up from where you are to the FTSE 100, that's expected to attract some flows. But equally, obviously, you can get these basket trades. So there has been talk in the market of potential higher share price volatility. We will see. In terms of deal costs, Willis Towers Watson is actually making a significant contribution, which I've read is about 7.5 million to make this all happen. So this is expected to be at nil cost to ATST shareholders. It's also expected to be at nil or a very low cost to Witan shareholders, but this will, to a certain extent, depend on the level of the take-up of the cash exit and ergo what's left over. One of the other attractions for Witan's board is that Alliance Trust will basically retain its sort of holdings in the other investment companies and the other sort of specialist assets that it holds. So these are its secured loan notes. These will all be innovated over to ATST, but they do not form part of the new vehicle's long-term strategy. But sort of crucially, there's not going to be a fire sale of these things. So they are of the view that it's not the right time to sell them, as men are out of favour, but equally they are not putting any timeline on the sort of sale of these. The idea is doing it in a measured way that's really going to maximise value for all shareholders. In terms of timings, document's supposed to be published next 6 to 8 weeks, and it's going to require approval of both shareholders. The meetings for that are currently expected sort of late September, early October, and then assuming all goes to plan, implemented early in the fourth quarter. Just want to touch a bit more on the sort of whole fees thing. So the sort of fee rate, I've pulled this out of the presentation they did just after they'd announced this. But basically, you're sort of looking at 50.5 basis points annual management charge, assuming it gets that sort of size. And obviously, you've got a little bit of fixed cost to factor up, and that's what brings it up into the mid-50s. But that's obviously an improvement on where both funds are, particularly for Witan. But obviously, it's very, very attractive. Just covering the dividend in a bit more detail. As I said, Alliance Trust is going to see its third and fourth interim dividends moved up to sort of get to where the Witan level is. And Witan shareholders, in lieu of a second interim, they're basically going to get what is being called an interim pre-liquidation dividend, basically to bring everything into balance. And it's expected to be at least 1.75 pence per share. The idea behind all of this is that, say, total dividend Witan shareholders will stay progression on previous financial year, circa 4%. Obviously, total dividends to ATST shareholders, because they're being uplifted to match this, you're going to see about a 6.4% increase. The key thing is it preserves the dividend hero statuses for both funds, which I think is sort of quite key. For those who are interested, this just gives some idea of what the dividend profile is going to look like. Markets welcome the deal. As I said before, it seems like a logical fit. I mean, some people have been talking about maybe, JGI was probably considered as an alternative, but, this has got a strategy that is much more aligned. Obviously, they're both big global funds, multi-manager, similar yield, both a good size, both sort of long heritages. And it kind of fits the sort of mantra of, consolidation in the wealth manager space. A lot of these guys are saying, they need larger, more liquid vehicles to stay relevant. And, this will provide that. As I say, the FTSE 100 inclusion, assuming that comes, and it should do, is sort of seen as generally good, but, there is this sort of double-edged side of it because of the market trades, and it might create a bit more volatility. I think the assumption is that, the combined vehicle will still continue to sort of roughly defend that 5% discount level that's been in place basically since Willis Towers Watson took over. Just very quickly covering interim results of Bankers. Basically, there's been a strategic review that came out of its poor performance in 2023. I kind of want to talk about this because there's a little bit of a parallel with sort of what's happened with Witan and Alliance Trust and the successful process that follows. So they're basically saying, look, a number of stocks and regions have grown over the past decade. They've described it as sort of creating conflicts. You've got dual listings, M&A, changing dynamics of sectors, and it's been hard to keep up with. And the idea is that that really has sort of impacted performance. So really what they are doing is they are going to consolidate this. They're bringing the number of holdings down. It's going to be a bit more concentrated. And the idea is to really focus on stronger ideas. So number of region is going to four: North America, Pan-Europe, Pan-Asia, and Japan. They will continue to invest a bit directly in UK and China, but there are going to be single investment teams overseeing those. The idea is they'll have sort of greater scope to invest more capital in the best companies, whatever those regions are. Jamie Ross is going to manage the Pan-European portfolio. Satdura is going to manage the Pan-Asian portfolio, but still under Alex sort of Crook's guidance, as it were. As I say, the whole idea is to concentrate the portfolios, as with the large number of smaller positions, it just wasn't performing, and they're trying to get that down to about 100 in total. We are talking sort of regional portfolios, about 20 investments, and that is exactly the kind of thing that, as I say, Alliance Trust does, and it's done very successfully. They do say there's going to be a bit more in the US because that's a very deep market, and there's just significantly more listed companies and therefore opportunities, and they expect to get this all done by the end of October 24. They've already been doing it a bit, and if you sort of believe the impact has been felt in the half-year results, it seems to be working because they've beaten the benchmark a little bit. Now on to sort of JB Morgan Global Core Real Assets. That's had its annual results out, which I think Chairman described as deeply disappointing. NAV total returns not terrible, minus 4.4%, but equally not good against what's sort of happening in the wider market. Share price total return minus 20.9%, which was largely reflected in quite a significant discount widening. 30.5% at the year end. It's around 17.5% this morning, but it's been around the 20% mark recently, but did peak at 35. Really, the buybacks have been bringing the discount down, and they've sort of been doing that quite aggressively. Returns have been hit particularly by their poorly performing real estate assets, which I reckon is largely a function of higher interest rates. I mean, you can get a yield of 5.5% on that day, but having looked at all this, they have concluded that JARA's investment proposition is something which does not meet the needs of a particular group of investors, and ergo, they are changing it. And this is really driven by the continuation vote approaching. If this passed, the board says it's going to increase the frequency of that vote, which I think is currently 5 years. They're going to do it every 3 years. So next one will be in 2027. The problem child being real estate is around or just over 40%. They're going to bring that right down, and they're basically going to deploy the proceeds in what's been better performing infrastructure and transport sectors. They're going to continue with the buybacks, and they're saying actually they are getting good yields in these sectors, and they're expecting that to flow through to a higher sort of yield for JARA. The sort of continuation vote requires a simple majority to pass, but the board has been quite clear that actually if a substantial minority are against this, they're not going to keep these sort of guys locked in. They will think about it again. So you need to watch that space because it's a reasonable size. I think it's about 157 million market cap when I was looking this morning, but equally it's not that big. Finally, I just wanted to talk about Home REIT. Its long-awaited 2022 accounts are expected to be released in August 2024. So, that's going to make interesting reading and good news for beleaguered Home REIT shareholders. They have said that the audit is now substantially complete for the 2022 year, but the auditor has requested more time to finalise the audit, which is probably not a great surprise, but it is good to see that we're actually finally seeing some progress there. No doubt all of these things are being done in tandem. They do actually say that the accounts for the year to August 23, as well as the interim results for the period to February 23 and 2024, are expected to be published during the third quarter as well. So, really not a sort of long timeline before we sort of finally see that hopefully cleared up. And that should allow the original directors to finally step down from the board. They have basically said that they would hang on, I think, to take the flak for what's gone on in the year to August 2022. So that should allow a sort of tightening up there. Right, okay, so that is the news for this week. So without further ado, so it's just the disclaimer there. If you guys take a moment to look at that, and if you haven't got time to look at it all now, sort of come back to it. There's important stuff there. But now we want to bring on Nick Train of Finsbury Growth and Income. Just got a little bio of Nick here. I mean, Nick is sort of very well known face within the investment company space. Been doing this for a long time. Sort of very well regarded, super track record. For those of you who might not know Nick sort of co-founded Lindsell Train in 2000. He's the firm's chairman. He is portfolio manager for UK equity portfolios and jointly manages some global equity portfolios. And basically, he's been doing this for about 40 years. Before founding Lindsell Train, Nick was head of global equities M&G, having joined there in '98 as a director. He also spent 17 years at GT Management, where his final role was CIO for Pan Europe. And basically, he's got long investment track records in both UK and global equities. Hi, Nick. Thanks for joining us today.
Morning to you. Yes, you might have noticed that a very long time ago I studied history at university, and you've certainly delved back into many decades of history with that intro.
Well, we do our best, Nick. Yeah, I think so. People are very excited to hear from you today. Obviously, we're going to talk about Fidget. Obviously, you, as I've said, you manage a number of things. But we're going to specifically talk about Fidget. Can you just spend 10 minutes or so just giving us an intro to the fund? I mean, I think it is well known, but I think people would like to hear it from the horse's mouth, as it were.
The elevator pitch,
The
as it
elevator
were.
pitch. Yeah, absolutely.
Yeah, come on. Let me attempt that. I'm really interested in the interactive part of this session, but
Yeah.
but let me just give a quick introduction. So it's a UK equity mandate, Finsbury, for good or for ill. It's not been the most notable period for UK equity returns, certainly over the last decade. Nonetheless, I and my team have been running FGT for nearly quarter of a century. If you'll let me say it, I'm really proud of the long-term return. I think it's really quite competitive, but I'm also the first to acknowledge that I've been disappointed, and I know that other shareholders have been disappointed by the shorter to medium term returns, in particular since the end of COVID. The strategy has lagged, and there we are. That's the situation we find ourselves in. I've got three super succinct things to say about the investment approach, and maybe the first is important because you've already highlighted it a couple of times, Matthew, in your introductory comments. Finsbury is a highly concentrated investment portfolio. We've got 20 stocks only. And, as you remarked in a different context, that can cut both ways. If the stocks are working, you get fantastic performance. If they're not working so well, then, the concentration cuts both ways. But it gives you the chance of delivering the returns that you want, okay? So it's a very concentrated portfolio. It's also very strategic, by which I mean we don't do much. So just to put that into context, only 3 new holdings since 2020, okay?
Wow.
So the opposite of hyperactivity. I think the third thing to say, and again, just to colour some comments here, the portfolio is built around what we really like. And what we really like are data companies, software companies, and we've had some issues here, and the owners of great consumer brands. Yeah, that's essentially where we're fishing to create this concentrated portfolio. Now, 2 ways just to give you a perspective on the concentration. The top 6 holdings in Finsbury today are all at or above 10% of NAV. Yeah. So 60% or more of the NAV is in just 6 holdings. All FTSE 100, all substantive companies. I'm going to list those 6 because 6 isn't that many. And I'm going to guess that most people will have heard of them. But I just want to be clear what it is that we own in such size and why. The biggest holding is RELX, which is, amongst other things, the world's #1 scientific publisher. Second biggest holding is Experian. Experian is the world's biggest credit rating agency, and that means Experian has more data on more businesses and, crucially, more individuals than any other entity on the planet. And in the third decade of the 21st century, when data is the new oil, Experian is very, very attractively positioned. Our third biggest holding is the London Stock Exchange Group. That's the world's #1 real-time financial data provider. Fourth biggest holding is Unilever. Dull, boring, plodding Unilever. But when you look at the direction that Unilever plods over time, given its incredible array of global brands and markets all over the world, Unilever plods steadily forwards. So to us, it's a valid holding. The fifth biggest holding is Sage. Sage is one of the vanishingly rare companies on the London stock market that is a world-class software business. And just as a nuance here, which we find particularly exciting about Sage, Sage is winning in the biggest market in the world for software and innovation, which is the United States. We're really excited by Sage's market-leading growth in the USA. And then just to round out this 6 biggest holdings, our 6th biggest holding is Diageo. That's caused us a lot of pain over the last 18 months, owning Diageo. We've been adding to that holding. Diageo, as everybody knows, is the world's biggest premium spirits company. And we just it's almost an article of faith, which maybe doesn't sound enough. But when you look at the collection of premium, super premium brands owned by Diageo, that company must be well positioned for any eventual decline in global interest rates and upturn in consumer confidence. Okay, so those are the 6 biggest holdings. I said I had 2 ways to think about portfolio concentration. Matt, with your patience, with your viewers' patience, I just want to share the other, because this perspective on concentration is very different and, to me, very, very promising. I said to you that we like data companies like RELX or software companies like Sage. We have 6 FTSE 100 companies that are data, software, technology platform businesses, 6 holdings which combined make up over 50% of the portfolio. By contrast, the combined weighting of those 6 businesses within the benchmark is only 8%. So, we've created a massive differential between this collection of, in our opinion, world-class data and software assets and their weighting in the UK stock market. All of these businesses have done well as businesses over time, and they've all done well as share prices over time. RELX, our biggest holding, I've already mentioned it, hit an all-time high yesterday, thank goodness. One of our 6, a technology platform business which everybody is going to have heard of, Hargreaves Lansdown, that's one of the 6, as you may or may not know, has received an indicative approach from private equity. We'll see what happens there. But yeah, this sense that this collection of data and tech platform businesses, things are happening for those holdings. That's reinforced, and it's such an important part of Finsbury's portfolio. So I might just summarize, although I've already said this, but listen, I will say this. Trackers, ETFs, passive strategies, these are relevant ways for anybody to think about taking equity exposure. They truly are. All I would say is that if you're considering investing in an actively managed investment strategy, then make sure that there is enough, in inverted commas, activity. And I don't necessarily mean buying and selling, I mean the shape of the strategy. Make sure there's enough activity to justify the fee that you're paying. All I can assure you, and as I say, for good or for ill, all I can assure you is that Finsbury, it's a very, very different portfolio. And I sincerely hope that the different is going to be good different rather than mediocre to poor different, as it's been for the last 2 or 3 years. But what else can I say?
Yeah, no, absolutely. I suppose sort of on that question of activity, I mean, I like this because I think it does what it says on the tin. But you've added sort of 3 new holdings in the last, what would you say, since 2020, was it?
Yeah.
And if I remember rightly, you don't really sell anything. You know, you seem to sort of add to things when they're cheap, when they're sort of out of favor, and then ride that sort of re-rating. Obviously, things that you really like, and you've got long-term conviction in. But surely it must be pretty hard to sit on your hands. I mean, how does that actually sort of work in practice?
Well, you're right. And listen, me, Michael Linsall, the team of people that work with us, we don't for an instant claim that we found the solution to the investment management challenge. Investing's really difficult, particularly active investing. But you observe that there are certain mistakes that recur time and time again for let's say professional fund managers, maybe for amateur investors as well. And one of the obvious mistakes that people recognize in hindsight is that they trade too often. They're not patient enough. They're always chasing the latest hot idea. And as a result, portfolios never really stay stable long enough to get the benefit of a good investment idea. And also there's a tendency, and you alluded to it, there's a tendency for portfolios to get overly diversified. You suddenly look up and you realize, I thought I was running a concentrated portfolio, but actually I've got 70 stocks now, and I don't really know why I own half of them. Now, all I'm saying is that we've disciplined ourselves to try and avoid those types of mistakes. So we try and keep the portfolio super focused, and we try as much as we can to trade and interfere with the portfolio as little as possible. You're quite right. We rarely sell. I mean, I can think of, since 2020, maybe 2 or 3 sales, one of a substantive holding. Others, we did sell some scraps of things we'd hoped to build a position and it didn't work out. But you're right. The toughest thing, and I don't know whether this resonates with the people listening to this, is doing nothing is psychologically very difficult, because hindsight tells you how obvious it was, the thing that you didn't do. But there is this dividing line between the future and the past, and always the present is a time of maximum uncertainty. And your instinct, and I promise you, your brokers and the media will be trying to encourage you to be active, because that's what drives the industry and it's what makes headlines. Again, we've just tried to recognize how little we truly know about the future and to observe trading is expensive, and maybe we're better off trying to minimize it. But it's just an approach.
Yeah. I mean, that actually kind of sort of pays into a question that's popped up here. Somebody sort of said, with the buzz around AI, would you be interested in growing the technology allocation in the fund?
The answer is yes. I will just reiterate this point, because actually some people have already said, wow, that's quite risky what you've done. And I think it is quite risky what we've done. We already have half the portfolio invested in companies that are clearly beneficiaries of developments in digital technology, including AI. In fact, the 6 companies that I kind of alluded to, all of them have existing AI enhanced services. But I do wonder whether 50% is enough. The way that markets are changing, new industries are developing, companies are getting bigger than anybody ever believed was possible. Actually, I expect that we need to continue to increase that current weighting. We have around half the portfolio. I pray that some of that comes from further capital gains from the existing positions we have, but I expect there will be some new additions to the portfolio as well. I mean, maybe just to highlight the most recent portfolio addition, just to corroborate what I've said about looking for new ideas that help us capture that data AI type theme. The most recent portfolio holding is Rightmove. I guess everybody knows Rightmove. The interesting perspective on Rightmove to us, and it's the perspective that the chief executive shares, is that Rightmove is actually a data business. Those billions of contacts that it has every year with consumers interested in the property market in the UK give Rightmove an access to a flow of data that no other company can match. And what Rightmove is being increasingly clever at doing is applying learning models, digital tools to that data to create new products and services for its customers. And yeah, I think that Rightmove could well be perceived. It isn't at the moment, because the share price is doing nothing. Indeed, the share price is down 30% from its peak of a few years ago. But we have high hopes that Rightmove may be perceived as a AI advantage growth business again. And if that happens, the rating will change a lot.
Right.
Upwards.
Okay. Is there anything else you would add to that? Because somebody's actually asked to sort of explain the whole sort of rationale with Rightmove, but I think you've probably pretty much covered it there.
There are very few companies, even amongst I mean, I think we own some great businesses in Finsbury, but there are very few that have an equivalent share in what they do as Rightmove does. What is it? Something like 87% of all consumer visits to a online real estate, 87% of the visits are to Rightmove. It's just an extraordinarily dominant position in a very, very important market. And to be honest with you, I wish we'd owned it longer ago, but anyway, we didn't. But there has been an opportunity, in our opinion, presented by the interest rate cycle. When rates went up, Rightmove share price fell, and we said this time we really must start accumulating a stake in this in this business. While the thought is in my mind, and I sort of say this a little bit provocatively, this is another stock that hasn't worked for us yet. But I say that, is there a company, another UK company that has quite such a dominant share of what it does as Rightmove? Another one that I think does is Fevertree.
Right.
If one accepts, and I think you can do, that Fevertree has created a brand new category, premium mixers.
Yeah.
The pricing differential between Fevertree's products and Schweppes or anybody else, it's very wide because Fevertree's created a new category that has value for its consumers.
Yeah.
I mean, Fevertree, it's you know, it's head and shoulders, it's orders of magnitude bigger from a global perspective than any of its competitors. And again, we've got high hopes that Fevertree's business will keep growing globally, and if it does, it's cheap.
Yeah. No, I find that entirely relatable. Mrs. Reed won't drink anything else, so there you go. Just
Mrs. Train wouldn't dare drink anything else. I drink the Tanqueray.
Oh, right.
Which
Okay.
is
Yes.
which is a Diageo brand, of course.
Also in the portfolio, I believe.
Well, Diageo, as I said, is one of the top 6 holdings we have.
Yeah. Just quickly on Rightmove. I think you've answered this question already. But sort of somebody has just asked about CoStar, but as I say, I think the sort of market share argument kind of answers that. But somebody said, are you not concerned about that because it's a fierce competitor? But I think the answer is no, given that Rightmove's got 87% of the market. Is that a fair comment?
It's not quite a fair comment. Because the question is a well-posed one. The entrance of CoStar to this market certainly ratchets up the level of competitive pressure. And I think all one can say is that history, the past suggests that the dominant incumbent, it's very, very difficult to displace the dominant incumbent. The new entrant has to offer something radically superior to the incumbent. Now, Rightmove's service to consumers is free. That's a pretty good marketing tool. Unless CoStar is going to start paying people to come to its site, which I'm skeptical. I'm optimistic that Rightmove, as it has in the past, will see off other competitors. I do think there's a nuance here, though, that I'd just like to highlight. I'm not one of the people who says, oh, the UK's performed so badly that the whole market is an incredible bargain and you ought to be buying the UK. I'm really not. At the index level, I'm not sure about that. But at an individual stock by stock level, there are some extraordinary divergences between the way that a UK company is valued and, let's say, a US company is valued. And to me, CoStar versus Rightmove, it's kind of it's an incredible difference. CoStar's been a successful company. Probably will carry on being successful. Maybe it's going to be successful in the UK as well. We'll see. But if you want to buy CoStar on NASDAQ, you have to pay over 60 times earnings. That's what you pay for a growing tech platform business in the States. We've been buying Rightmove. Okay, the price has come back a bit, partly because of CoStar, partly because of interest rates. We've been able to buy that in the low 20 times earnings. It's just a huge gulf, and I'm not saying it's going to close, but I think for people who think, in a beaten up market like the UK, I wonder if there are some nuggets in the UK stock market that might have got dragged down along with the rest of the index. I think that's a fruitful way of looking at the UK, and maybe I would dare to suggest that Rightmove, if Rightmove was listed on NASDAQ and had those market shares, it would not be trading on 21 times earnings.
No. In fact, you're quite good at this, Nick. You managed to answer another question for me. Somebody said, can you share your view on the sort of UK value or valuation opportunity? I think that probably sort of sums it up. There was sort of kind of a follow-up question to that. They have said, sort of with the success of some of your non-UK holdings, would you consider expanding the sort of non-UK allocation?
Okay, well, I might say a bit about both, actually. Again, because I want to be absolutely clear about what we're doing. Do you know, I'm not absolutely sure today what the price earnings ratio is for the FT All Share Index, but maybe about 14 times earnings. I mean, that's a low valuation. Yeah. The weighted average valuation across Finsbury's portfolio is over 20, probably about 21 times earnings. So whatever else we're doing, we're not offering investors access to the super cheap, super beaten up areas of the UK stock market. And I have to say that's deliberate, because there's a lot of the UK stock market that is not very interesting companies with 20th century business models and no clear route to relevance as we get deeper into the 21st century. So for me, no one has to agree with me. I would rather pay just over 20 times earnings for businesses that I believe are getting more relevant as we get into the 21st century than only a collection of beaten up low growth or cyclical businesses. Now, I mean, that's just my opinion, but I just wanted to be clear about that. And in answer to the second question, we have a handful, less than a handful of non-UK listed companies. Actually, I've been selling them, not because I don't like them. I do, but because the opportunity and the valuation of the stuff that is London listed that we own, I think that the opportunity is so obvious that I want to bring that capital back into those UK listed companies.
Yeah, no, that sort of makes a huge amount of sense. I mean, I remember talking to you about this sort of years ago, and at the sort of time with the sort of brands that you were buying, you sort of used to say, you wanted to buy things that you thought would exist and sort of be relevant in 100 years time, or a sort of very, very long time frame. I mean, the world seems to have got faster, and with sort of technology disrupting, do you think the way that companies sort of remain relevant, or sort of how you look at the portfolio, do you think that has changed at all?
I think the short answer is yes, I do.
Right.
I do. I think that it is evident that private label, copycat brands are eating away at some mainstream consumer brands, and probably that is accelerating, and probably consumers' preferences for spending marginal wealth that they have is increasingly on digital experiences or on really luxury, real heritage, premium, super premium brands. And I think looking back at me 20 years ago, I would have just said consumer brands good. And I think I would now say consumer brands where you can see why customers might aspire to own or consume those brands as they get wealthier over time. That's maybe a nuance. I do, though, these are crazy. No, they're not crazy markets, actually. I don't think they are crazy, but there is extraordinary volatility.
Yeah.
And I mentioned earlier Unilever as part of our portfolio. Yeah, it's part of the portfolio. I do think that owning businesses like that as part of the portfolio, where there are enduring brands that maybe aren't growing very quickly, but are highly likely still to be around. And I think, Dove is highly likely to still be around in 10 years' time. Hellman's is highly likely to be around. Having some the rapidity with which you can make and lose money in tech, it's thrilling, but it's also shocking how quickly tech value can just evaporate.
Yeah.
And having part of your portfolio invested in things, even if they're not so exciting, but where you can see the stability, to me, it makes sense.
Yeah. Yeah. Just a couple of questions, actually, that sort of relate to the things that we've been talking about, just on the sort of luxury brands a moment ago. Obviously, we're talking about things that people want to aspire to. So if somebody's asked, what's your sort of view on the drop in Burberry's revenues?
Disappointment is my response. It's been most unhelpful for our performance over the last 12 months. I mean, in short, what I would say is that we are thinking hard about when we might want to add to the holding. And we're thinking hard about that because actually we have no doubt, and we've had a lot of corroboration around this, we have no doubt that the core traditional Burberry offering, particularly its trench coat offering, that outerwear offering, that is a true luxury, durable position that this company enjoys. And that's not going away. It's not gone away. Maybe the company's made mistakes recently trying to elevate the fashion aspect of what they do, and that's up for debate. But there is at the heart of Burberry, and well, just to reuse this terminology, an enduring, unique, and valuable global franchise.
Yeah, makes a lot of sense. Just very quickly on sort of Unilever. Somebody sort of said Unilever grew EPS by a cumulative 7% in the last 5 years. Share price in the same period has fallen by 10%. If sort of earnings growth is not reflected in the share price, why hold it? I mean, I think it is for the stability, presumably. Is there anything you'd add to that?
Well, I would say that history is dangerous. It doesn't necessarily repeat itself. I absolutely, but I would say also look at Burberry Unilever over 20 years, or also look at it even over 50 years. That this is a consumer brand company that over long periods of time has developed or acquired new brands that it's been able to build into globally successful properties because of its marketing expertise and because of its incredible global distribution platform. And I'd say if you wanted to be optimistic about Unilever, look at the last set of results. In the last set of results, over a quarter of Unilever's revenues now derive from premium beauty, health, and well-being brands. Over a quarter of the company are in those categories. 10 years ago, they had zero in those categories. So over a 10-year period, they've been able to build and buy a new set of brands that have been growing and that are obviously relevant to their customers. And that's what Unilever's always done. Look at a really long-term share price history of Unilever. It has long periods of going to sleep. And that's frustrating when that happens. But the trajectory has been upwards over long periods of time. If the company can allocate its prodigious cash flows smartly, then there's no reason why that shouldn't continue. That's all I'd say.
Okay, super. Question here that sort of relates to this. Do you think it is better to hold sort of boring, in quotation marks, albeit market-leading businesses when they are relatively new, fast growth businesses that could generate a sort of greater potential investor returns?
Yeah, it's you know, it is a question. Sorry, I'm just organizing some thoughts here.
No, not at all. Not at all.
So okay, one of the things we don't do, and you can't do everything, okay?
Right.
One of the things we don't do is invest in young, speculative, unproven companies.
Yeah.
And that, no doubt about it, closes off to us the opportunity to make incredible wealth in short periods of time. But it also closes off the statistical certainty that many of these young, speculative, unproven companies simply aren't going to make it. Let me, anecdotes are useful, but they're dangerous if you extrapolate too widely from them. But can I share an anecdote with you which sort of captures the effect we're trying to capture? 40 years ago, 1984, the FTSE 100 was first constituted. We just had the 40th anniversary of the FTSE 100 index. One of the constituents of the original FTSE 100 was RELX, which is our biggest holding in Finsbury Growth and Income Trust. RELX, over the last 40 years, so it was already a big company 40 years ago. It was in the FTSE 100. RELX is the single best performing constituent of that original FTSE 100. £100 invested into RELX has turned into over £30,000 with dividends reinvested. That's been an incredible growth business over 4 decades. It's now the 7th biggest company in the FTSE 100. As I said earlier, it hit an all-time high share price yesterday. Now, I know this is just a matter of opinion, but when we look at RELX today, what is it, a £50 billion plus market cap? To us, the prospects for the company look actually better than they did 40 years ago. So why shouldn't it continue? Why shouldn't it continue? What we're trying to do is find substantive companies with clear moats and competitive advantages where you can see how there is many decades of growth and opportunity ahead of them. And I think that's true of Rightmove, which is at the lower end of the FTSE 100, and I think it's true of Experian, which is a top 20 company in the FTSE 100. I think the other perspective here is that the world is a very big place indeed, and digital technology has created very big opportunities for advantage companies indeed. And I think you could argue really quite rationally that, say, LSEG, London Stock Exchange Group, I think that's the 12th biggest company in the FTSE 100, but it's a 40 billion sterling market cap.
Mm.
By global standards, that's tiny. It's tiny. And yet it's got really, really important positions in the entire global financial market infrastructure. It could be, it could be a 200 billion pound
Yeah.
company. And still that would be small compared to the US giants. So
Mm.
I think a fruitful way, or the way I try and discipline myself to think, is I'll even say, okay, let's look at the top 25 companies in the UK stock market and look at them as though they were small companies. Because actually, by global standards, they are small companies.
Mm.
Are they small companies with a big growth opportunity?
Mm.
And I hope we found enough of them.
Yeah. No, I mean, that makes a lot of sense. I mean, I think the sort of sense that I'm getting this is literally about the sort of ability to compound the growth. And maybe helps us get a bit of sense of scale. I know you used to sort of talk in terms of, baggers where things had sort of doubled and doubled again. And I'm just thinking, given the sort of long term sort of way you tend to hold these things, I mean, how many really good baggers have you got in the portfolio? Can you give us some sense of scale of that?
Well, can I say from when we first started buying them?
Yeah.
Because, obviously we might have had inflows and we've added to holdings which, maybe will
Yeah,
have
it's complicated.
reduced
Yeah.
but um, Burberry is that's been a horror show for
Mm.
us over the last 12 months.
Yeah.
I mean, the price is £9 today. It peaked at over £20 a year ago. I mean, it's bad. But we first bought Burberry in 2009 below £2 a share.
Mm.
Um, and Burberry actually has grown quite a lot
Mm.
since 2009 because people do like those trench coats.
Yeah.
They seriously do. I'm not imagining that. They like those trench coats. They like the scarves. I mean,
Yeah.
there's something real in this
Mm.
company. Um, I don't know. I think Unilever's share price was probably £5 or £6 a share back in 2002 or something. It's 44 today.
Yeah.
Experian. Now, listen, I must admit, we bought Experian in 2020, but Experian listed in 2006, and the stock is up sixfold since 2006. Yeah, we bought Sage in 2002 at
Mm.
£1.50. That's trading at over £10 today. Yeah, there are plenty of examples actually of fine UK companies that have done pretty well
Mm.
over time, um, as long as they're in the right sort of categories.
No, that makes a lot of sense. I'm conscious of the time. I think we've maybe got time for, there's plenty of questions here. Um, Plenty of sort of, questions to sort of run through, but I just want to focus on something that's relevant. In luxury, would it be better to hold something like LVMH or Keyring, sort of reflecting the difference in the sort of popularity of their brands? Which would be better?
Depends if you're running a global strategy
Yeah,
or you've been mandated to run a UK strategy.
yeah.
Listen, it's not our proudest moment at the moment,
Mm.
Burberry, but we were talking to I think a really first class analyst on Burberry
Mm.
yesterday, whose view is just beginning to turn more positive on Burberry,
Mm.
and they say, not only is Burberry the only luxury company
Mm.
listed on the London stock market, but their view is that Burberry is, quote, the king of global trench coats. It's also quintessentially British and it's associated in global consumers' minds with the buzz and the majesty is the wrong word of London. Yeah.
Yeah.
And so, yeah, Burberry's not Vuitton, it's not Hermes, it's not Gucci, and it never has been, and it probably never will be. But does it stand for something? And is there something uniquely British about it? Yeah, I think there probably is.
Okay, super. Given the time, I think we need to wrap it up there. But that's been great. I think we've covered a heck of a lot of ground. As I say, couldn't get through all the questions, so sorry to anybody who we didn't get to. But I think we'll just have to get you back in a year's time, Nick, and just see how it's all going. But
Always
been really, really useful. And it's been just great fun to do. So if you just all bear with me a sec, I think I just need to get the presentation back up again, because I just want to tell people what we've got coming up. So as I say, that was Nick. There are a few things we might have looked at. So just very quickly, once again, disclaimer, please take a moment to look at that. Obviously, we're going to have the recording up on the website shortly. If you don't get time, definitely come back and have a look at that, because there's some important stuff in there. And then just over the next few weeks, obviously, we've had Nick today, but we've got James Baker from the investment company next week. And then on the 12th of July, Kenneth McKenzie from Target Healthcare REIT, I think Richard Williams will be doing that. 19th of July, Chris Clothier from Capital Gearing. 26th of July, Henry Butt of AEW UK REIT. And you can see we're even sort of filling up things for August. And obviously there will be more coming up. But thanks everybody for joining us today. Thanks ever so much, Nick. And we'll see you again next week. Bye for now.